Imagine this. It's 14th century Italy. You're chilling on a bench in Florence, counting gold coins, wearing a tunic, and accidentally inventing modern banking. Haha, sounds dramatic, but that's pretty much what happened. Before the skyscrapers, stock tickers, and crypto bros, banking was just guys with ledgers and big egos trying to manage trade, trust, and other people's money. So how did we go from pawnbrokers to billion-dollar hedge funds? Let's rewind. Hey, welcome back to the channel. I'm Drewy, and if you liked the last video where we talked about why money isn't even real, then buckle up, because today we're looking at how people started lending that imaginary money to each other, with interest. We're going deep into the origins of banking, the legendary Medici Bank, and how ancient principles still shape our economy today, for better or worse. Humans have been borrowing and lending for thousands of years. We're talking 5,000 years ago. Mesopotamia, clay tablets, sheep IOUs. But actual banks, as we understand them, didn't appear until the 14th century, mostly in northern Italy. Fun fact, the word bank comes from the Italian word banco, meaning bench, because bankers literally sat on benches in marketplaces doing deals. Italy at the time was a patchwork of powerful city-states. Thanks to their location, they were vibing as trade hubs between Europe, Asia, and Africa. Florence and Venice, big players. Venice financed sea voyages. Florence manufactured textiles and moved money. And that's where we meet the stars of the show. The Medici family. Medici Bank, founded in 1397 by Giovanni di Bicci de' Medici, changed the game. Before them, you had pawnbrokers, foreign exchange dealers, and local lenders. But Giovanni's bank? Whole new level. They did three things differently. Scale. Under Giovanni's son Cosimo, the bank opened branches in 11 cities, including London and Geneva. That was wild for the time. Next, decentralization. Each branch was run by a local junior partner who shared profits and took on risk. Meanwhile, the Medici family sat in Florence, controlling the brand and raking in profit. Third, big deposits equals big loans. Wealthy folks dumped their money in the bank, which allowed it to lend far more than it actually held in capital. Boom, early leverage. So why did this work so well? Three core concepts that still define banking today. Economies of scale. Writing one loan contract is expensive. Writing 1,000? Cheap per contract. Banks do money stuff more efficiently because of scale. Next, diversification of risk. With branches across Europe and local partners absorbing losses, the Medicis didn't put all their florins in one basket. Third, asset transformation. This is the real wizardry. Some people want to deposit money for safekeeping, which is short-term, while others want to borrow money for trade, which is long-term and risky. The Medici Bank bridged both. They borrowed short and lent long, making juicy profits off other people's money. But here's the thing. If too many depositors want their money back all at once, the bank can't pay them. Why? Because the bank already lent it out. This is called a bank run, and it's still a threat today. It's like musical chairs with your money. The upside? Banks connect savers and borrowers. The downside? If trust disappears, so does your cash. Therefore, these three concepts are refined principles of Medici Bank's modus operandi. Looking back, long-distance trade in the 14th century was sketchy. Goods took weeks to arrive. What if someone ghosted you after the deal? So Italian bankers invented the bill of exchange, a promissory note that lets buyers pay later and sellers raise cash early by reselling the note for less than face value. Banks started trading these like IOUs, and suddenly, paper promises had value. Sound familiar? This was the birth of international money markets. But lending isn't just math, it's psychology. The problem is, bad borrowers ask for loans more than good ones. Banks face information asymmetry, which is a fancy way of saying not knowing who's gonna ghost them. That's why good banking requires judgment, vetting, and monitoring to avoid moral hazard when people say, "Sure, I'll repay," and then vanish like your gym motivation. On a side note, have you ever wondered why banks cluster in the same cities? Think Wall Street, London, Hong Kong. It's called network externalities. As one bank sets up shop, others follow to share expertise, info, and talent. Florence was one early cluster. So was London with its goldsmiths. Even ancient China had a banking hub in remote Shaanxi. But clustering has a dark side. Herd behavior. When one bank panics, others follow. Reputation is everything. And since banks lend long but owe short, panic spreads fast. Example: in 1931, Austria's Kreditanstalt collapsed. That set off dominoes. Germany, the UK, then the US. The result? Global bank runs. Welcome to the Great Depression. Because of all this risk, banks are now heavily regulated. You can't just start a bank from your garage. Most countries require licenses, transparency, and limits on activities that can be performed. Banking is just one part of finance, the broader world that connects people with excess money to those who need it. Stock markets, mutual funds, pension funds, they all do the same thing: match money to productive use, and ideally, spread the risk so no single failure crashes the whole system. So yeah, from benches in Florence to high-frequency traders in New York, banking has always been about one thing: turning trust into money. If you enjoyed this video, check out my previous one on money and why it's not even real. Smash the like button, hit subscribe, and let me know in the comments, would you put your gold in a Medici vault? See you in the next one.